The financial landscape is undergoing a significant shift as the U.S. economy enters what Bank of America has termed the Goldilocks era, a phase characterized by balanced economic growth and controlled inflation. This optimistic outlook has put cyclical stocks, including those in materials, industrial, energy, consumer discretionary sectors, and parts of the technology sector, in a prime position to benefit. With the Federal Reserve poised to shift its focus from inflation control to supporting economic growth, the stars seem to be aligning for a potentially lucrative period in the stock market. However, this scenario is contingent on several factors, including the timely reduction of interest rates and positive earnings reports. As Goldman Sachs suggests, a prompt rate cut could further stabilize the economy and enhance market conditions. But what if the Fed delays its actions? How might this affect the delicate balance of the Goldilocks economy and the fortunes of cyclicals? The Goldilocks economy and cyclical stocks, an emerging opportunity. The Bank of America's recent analysis indicates that the cooler-than-expected Consumer Price Index, CPI report for June has set the stage for what they describe as a Goldilocks economy. This term, derived from the children's story, signifies an economic environment that is just right, neither too hot nor too cold, balancing steady growth with controlled inflation. According to BofA strategist Oh-Sung Kwon, this harmonious economic climate is particularly advantageous for cyclical stocks, which include sectors such as materials, industrials, energy, consumer discretionary, and some technology areas. The Goldilocks scenario hinges on the Federal Reserve's ability to pivot its focus from combating inflation to fostering economic growth. The June CPI report showed a significant deviation from economists' expectations, missing by 4.2 standard deviations, the largest miss since 1998. This unexpected cooling of inflation supports BofA's thesis that the economy is aligning towards a balanced growth trajectory. With inflationary pressures easing, the Federal Reserve can now consider measures to stimulate economic growth, such as interest rate cuts. Bank of America anticipates that upcoming economic data, including retail sales, industrial production, and housing starts, will further clarify the economic outlook. They predict a decline in June retail sales, which could bolster the case for interest rate cuts in the near term. If the Fed acts on this data and initiates rate cuts, it could create an optimal environment for cyclical stocks, which are sensitive to economic cycles and interest rates. Kwon highlights that the alignment of easing rate pressures, supportive Fed policies, and broadening earnings creates a perfect storm for cyclicals. The S&P 500, excluding the top 7 mega-cap tech stocks, referred to as the other 493s, is expected to emerge from an earnings recession. This broadening of earnings is crucial for sustaining the stock market's momentum. BofA expects a modest 2% beat on earnings per share, EPS for the current quarter, driven by the backdrop of slowing GDP growth and accelerating profit growth. The case for immediate interest rate cuts. Goldman Sachs echoes the urgency of interest rate cuts, advocating for action at the Federal Reserve's upcoming policy meeting on July 31. Goldman's chief economist, Jan Hatzius, argues that inflation has sufficiently moderated to justify an immediate rate cut. He points out that the median of the Fed staff's monetary policy rules now suggests a funds rate of 4%, significantly lower than the current rate of 5.25%, 5.50%. Hatzius outlines 3 compelling reasons for the Fed to cut rates sooner rather than later. First, the data clearly supports a rate cut now, eliminating the need for further delay. Second, cutting rates in July would mitigate the risk of a temporary resurgence in inflation, which could complicate a September rate cut. Monthly inflation figures are volatile, and a sudden uptick could make a September cut more challenging to justify. Lastly, political considerations play a role. Cutting rates closer to the November presidential election could be politically sensitive, making a July cut more strategic. Despite these arguments, the market is not fully aligned with this view. According to the CME FedWatch tool, there is a 92% chance of a 25 basis point rate cut at the Fed's September meeting, but only a 7% chance for a cut in July. Hatzius's call for a July rate cut highlights the potential benefits of acting swiftly to stabilize the economy and support growth. Conclusion: the convergence of a cooling inflation landscape, the potential for timely interest rate cuts, and the resulting economic growth create a promising outlook for cyclical stocks. The Goldilocks economy, as described by Bank of America, offers a balanced environment that could significantly benefit investors in rate-sensitive sectors. However, the timing of the Federal Reserve's actions remains critical. As the economic landscape continues to evolve, the question remains, will the Federal Reserve seize the moment to catalyze economic growth, or will delays disrupt this delicate balance? How do you think the Fed's decisions will impact the broader economy and the stock market in the coming months? Share your thoughts and predictions on this pivotal moment for the financial markets.